Okay, let's dive into a massive shift happening in the world of finance, and it all comes down to gold. This is the incredible story of China's very bold plan to change where the world keeps its most valuable assets, and what that really means for the global balance of power.
It all kicks off with this number. Just look at it, $300 billion. It's a truly staggering amount of money. And back in 2022, it became the trigger for a financial earthquake that's still sending tremors across the globe today.
Because that $300 billion, that wasn't a company's profit margin or a stock market valuation. Nope, it was the foreign reserves, the national savings of a major world power, Russia, and they were frozen almost overnight. This was a move nobody had really seen before on this scale, and it sent a very, very loud message to central bankers everywhere.
And that message immediately raised this deeply uncomfortable question. For countries all over the world, seeing Russia's assets get locked up made a theoretical risk feel terrifyingly real. All of a sudden, the safety of their own national savings, parked in Western financial institutions, was seriously in doubt.
So this single event, it triggered a huge global reaction. The fear that your country could just be cut off from its own money. Well, it sparked this frantic search for a safer, more tangible kind of asset, something you could touch, something that couldn't be frozen with the click of a mouse. And this chart just shows you everything you need to know about that reaction. Central banks went on an absolute gold buying spree, unlike anything we'd seen in decades. In 2022 alone, they snapped up over 1,000 tons of gold. That's the highest level since 1967. This wasn't just portfolio diversification. This was a fundamental panic-driven rethink of what financial security actually means.
And you know what happens when demand just goes through the roof like that, right? The price of gold skyrocketed, hitting all-time highs. This proved that gold wasn't just some shiny, nostalgic metal anymore. It was now a critical, strategic weapon in a new age of financial warfare.
And this is where China walks onto the stage. But not just as another country buying up gold. Oh no, they had a much bigger, much more ambitious plan. Beijing saw this global fear, this growing lack of trust in the Western financial system, and they decided to offer an alternative. They positioned themselves as a potential safe harbor in this new, uncertain world.
So what is this grand plan exactly? It's what's being called a gold custody strategy. They're actively going to other nations and saying, hey, you should buy gold, and more importantly, you should store that gold with us in secure vaults right there on Chinese soil, all managed through their massive Shanghai Gold Exchange.
Let's just walk through how this works, because it's pretty slick. First, China targets friendly central banks. Second, they use their powerhouse gold exchange, the SGE, which is already the biggest physical gold exchange in the world. Third, and this is the really clever part, they're targeting new gold purchases. This makes it a much easier yes for countries that might be nervous about moving their old stockpiles. And finally, of course, it's all stored securely inside China's borders.
So, what this move does is set up a classic showdown. You've got the reigning, undisputed champion of the global gold market for centuries, London. And now you have the ambitious new challenger, China, coming in with a completely different sales pitch.
And what's so fascinating is just how different their offerings are. I mean, look at this. London's value is built on over 300 years of trust and incredible liquidity. That's the ability to buy or sell huge amounts of gold instantly without messing up the price. It handles something like 90% of all global trading. It's the safe, established bet. China, on the other hand, is selling something totally different: protection from Western sanctions and a chance to align with a different geopolitical power.
And this quote from an industry expert, Nicholas Frappel, just nails the core dilemma here. It really boils down to a trade-off. Any country thinking about this has to weigh London's unbeatable convenience and liquidity against the geopolitical insurance policy that China is offering. You can't have both.
All right, so let's put ourselves in their shoes for a minute. Imagine you're the head of a central bank in a developing nation. What's going through your mind? This isn't an easy decision. It's a massive calculation with some huge potential upsides and some very serious risks. The rewards? Well, they're pretty compelling. Storing your gold in China is a direct way to hedge against the US dollar. It acts as a shield against the long arm of Western sanctions. Plus, it strengthens your economic relationship with the second largest economy on the planet, which could open the door to other perks, like better trade deals down the line. But, and this is a big but, the risks are just as real. The liquidity in Shanghai just doesn't compare to London, not even close. Siding with China on this could also get you some serious political heat from the US and Europe. And then there are the legal questions about how protected your assets really are. And the ultimate irony, The risk that in a future dispute, China itself could be the one to seize your gold.
So when you zoom out, you realize this isn't just about where countries are storing some shiny metal. This is about a potential redrawing of the entire global financial map. It's a long-term strategic play, and the consequences could affect all of us.
Right now, as you can see, the US dollar is still king. It makes up nearly 60% of all global foreign exchange reserves. But that share has been slowly but surely declining for years. And China's gold gambit? It's designed to speed up that trend, to chip away at the dollar's dominance by offering a hard, tangible, non-dollar alternative.
And you have to understand, this is not happening in a vacuum. This gold strategy is just one piece of a much larger puzzle. It fits perfectly with China's other big projects, like its CIPS payment system. That's their alternative to SWIFT, and of course, the development of the digital yuan. When you put them all together, you see the building blocks of a parallel financial system, one designed to operate completely outside of Western control.
Which brings us to the final and most important question. As nations around the globe weigh their options, this is the fundamental choice they're facing. Are we witnessing the start of a great trade-off? Is the world slowly starting to value geopolitical security more than the efficiency and ease of the current financial system? That right there is the multi-trillion-dollar question.